Hi, class. Welcome to Introduction to Investments. We're into Chapter 1. Chapter 1 talks about risk versus return. I think everything that we do in life involves a bit of risk. And every time we take a risk, hopefully it's a calculated risk, we determine if we're going to get a decent return for that particular risk. If you risk high within, let's say, the investment world, then your return should be high. That's kind of the concept. If you risk low, which low means a small amount of money, or not actually that risky, then you're going to get a less on your return. So that's what we're going to get into this particular chapter. Again, chapter 1. The PowerPoints that you see online are a little bit different than the ones that I present. I actually draft these PowerPoints so they can be more detailed and more, let's say, 2025 knowledge. So the first thing you should ask yourself is, how do I actually invest? This is called Introduction to Investment. We're talking about risk versus return. First thing you want to think about is get some knowledge. Find out what the stock market is all about. You want to get into, let's say, read books, jump online, Google, look for information. I talked to one of my students and he says, Professor, I believe in YouTube University. And I said, well, where is that? And I thought, wait, he's talking about online research. Because a lot of folks who have determined that some methods are better than other methods, they post that information on YouTube, make a video out of it. Some of them give you step-by-step directions. Funny enough, when I order things that I don't know how to put together, like let's say a TV stand or what have you, I go to YouTube University and I figure out how to do it. Same concept applies. If you want to learn more about the stock market and understanding investment, risk versus return, go to YouTube University. Practice, I always say practice, practice, practice with virtual money, which means not your own money. There are websites, there are banks, there are institutions that will actually have a software within their particular website that will allow you to track your virtual money and see if your stock investments actually might be worth your while. Also, you can apply for an account, which means you want to have your money managed, or you want to be able to invest. You want to actually purchase stock. You want to actually maybe redeem some of your stock, as we call that, sell your stock. You want to look at which stocks are more profitable. Right now, Tesla. Tesla's been through the roof, Amazon's through the roof, Google, and so forth. Find out exactly how much you may get on your return. Look at some of the fundamentals, algorithms. How does the stock market work? How do you track your investment? And if you're a savvy investor or very, let's say, a detail-oriented person, you might be good at managing your own finances. If you're not, try to get an investment firm. But watch their fees, because nothing is free. And then you want to actually place your limit. How much are you prepared to gamble? How far are you willing to go? And I would say the first thing you want to do is get your house in order. If you have your finances in order, your mortgage is paid in full or is paid on a regular, your car payment is taken care of, cell phone, you have something left over, I'd say take 10% of that and try to invest that into the stock market. Or put it into, let's say, an IRA, which is called individual retirement account. Think of ways to secure your future. So, congratulations. At this point, if you've done some of these things that I spoke to, you're an investor. All right. So now we're going to think about, as we go along, how to become a passive investor. As you can see by that icon there are methods on you being able to make money while you're sleeping. Passive investments. So now we get into, well, that all sounds good, KL, but what companies are out there? Well, the top S&P 500 stocks are, you can look right there, Apple, Microsoft, Amazon, Alphabet, Google, Facebook, and so forth. And then you kind of get an idea. Well, I got a kind of a concept now that there's top 50 or 500 companies in this particular S&P, which is considered an index. I kind of get that. You know, an index is basically a grouping of companies. In this case, 500 of the most profitable companies on the NASDAQ, or we should say the stock market. You said, okay, so I've got this part, kinda. So now, do I put all my money into like Apple? Now you think of diversification as you go along. So you got 25% maybe in the food industry, as you can see there, maybe 25% pharmaceutical, maybe, which I say 25%, maybe a little bit more in the AI robotics industry, and then maybe software and services. So there's 100%. Say, for example, you got $1,000, divide that by four different areas, and that'll give you more of a diversified portfolio, is what we would say. So if you think about that, for that 25% in the food industry, Coca-Cola is huge, Pepsi-Cola, and so forth. Pharmaceutical, Pfizer. What happened during the COVID-19 crisis? Pfizer made a lot of money. AI. Right now, we've got Intel, we've got Alibaba. That is huge. You get into software, Apple, Google. Everything we do comes from Apple, Google, Microsoft, and so forth. So think about those particular areas as investment vehicles. So let's get back into what is risk and return. Well, first of all, risk and return is financial management. Basically, is the risk associated with a certain investment and its return. Usually, high risk investments yield better financial returns. As I said in the beginning of this chapter, low risk investments yield low risk returns. They always say you have to put more in to get more out. So this is a risk of a particular investment is directly related to the return earned from it. So it's a simple math. You put 500 in, you may get a great deal of, let's say, stock. Determined upon how great the stock is, how valued that stock is, determines how much of a return you shall be getting. So risk. Let's talk about risk a little bit here. So the definition of risk basically is all investments definitely carry some degree of risk. We know that from stocks to bonds to mutual funds, exchange trades, and so forth. Exchange traded funds, I should say, which is called ETFs. You can lose. They can lose their value. You can lose some money. For example, you may start at, let's say, $1,000 and you get down to 800. How did that happen? Because of the stock market being, let's say, vulnerable, as well as in this particular climate being very, very volatile. So even conservative insured investments, such as certificates of deposit, which is basically bank deposits in your own bank. I work closely with California Coast Credit Union, and they ever so often offer a CD, we call it, or a certificate of deposit, and they'll give it to you or offer it, I should say, for a prescribed time. Last one I did was 90-90, which means, let me think this through. 9 months, $9,000 max, which you could actually put in at 9%, 999. They were doing their, I think, 90-year anniversary. So that's great. I'm thinking, oh my goodness, if I put in $9,000 or $900 based on the amount, for 9 months. So first I got to do is wait, it's 9%. So I have to divide that 9 by that 12 months. It's not 12 months, remember? It's 9 months, 999, 9%. So I'm not getting, wow, almost another $1,000. We're getting a different amount. You're getting right down to about 200 or 300 when it's all said and done. But that's a low risk for me because it's my money. It's an investment vehicle within the bank that I actually trust. So here's an idea of the strategy. How can you avoid some of the high risk? So some of the strategies, you're going to have to get around possibly the expense of your income tax, analyze your profit, analyze what's going to happen if you pull out some of your money. Because once you spend some of the money that you've invested in and that you've earned money on or earned interest on, it's taxable. Think of the policies. For example, municipal funds. Some of them are not tax based. You can actually get a municipal fund, which basically is through the city, through the state, and some governments, tax free. How do you control that? You lock it down. This is the kind of the concept for or strategy for avoiding some risk. Go through the process, review the process, find out the rules when you're actually investing in some of these vehicles. Vehicle just means another word for stocks or bonds or an investment portfolio, something that means you're putting money in somewhere and expecting money to come out. And once all these variables are considered, hopefully you have more of an improved strategy for avoiding some of the risk. Here's one of the areas that you probably want to be more focused upon and more excited about is return on your investment. So what is return on your investment? Here is the first step in calculating ROI, return on your investment, is to determine the total cost of the investment. Total cost includes more than just the price of the asset you purchased, but it also is investment fees. For stocks, bonds, that may include a commission. It could include advisory fees, those folks that look behind the scenes for you and invest your money. It could be markups. For real estate, that may include property tax, mortgage interest, insurance, and other upkeeps. So that's what you have to think about. Return on the investment. What are you going to get? What is your ROI really going to be? Here's a quick formula for you. So return on investment equals, here's the net profit divided by the cost of the investment times a percentage, 100%. So you'll find out that at the end of the day, what you've invested in, your profit is a certain percent. So a little bit more on risk and return. Risk and return, we talked about low, moderate, and high for a second. So if you have a low, let's say, investment, which means cash, and so forth, then you're going to have more of a low return. Moderate, which is fixed income securities, government bonds, corporate bonds, and so forth, more of a moderate risk area. And then high risk, that's where you got to really think about is equities, which is common stock, preferred stock, actually buying portions of a company, which we call buying shares. So that's something to think about when you're actually thinking about risk and return. So that was just an overview of risk versus return. All it simply means is how much you're willing to risk, how much far you're willing to go to sustain hopefully a really strong return. All right, so that was chapter one. Chapter two, we're going to get into mutual funds, investment for the masses. Thank you, folks.